how does today's decision figure into the big run-ups we've seen in gold and silver lately and a lot of the discussion over what that means?
Well, I think in some ways it adds to it because the problem is not what the Fed does during the pandemic. They know inflation's low right now, but we're going to build up government debt. We've got an awful lot of fiscal and monetary stimulus. If we don't pull back on that in late 2021 and 2022, there is an inflation threat. And I think that's one of the reasons why you're seeing this weaker dollar and stronger gold in recent days.
So, Mona, the question here is, are we facing a bubble in assets? And with the Fed, and if they can continue to assert their commitment to keeping interest rates very low, to not even thinking about raising rates, will we see that asset bubble, if you will, continue to expand?
Yeah, clearly what we have been seeing is a little bit of a Tina effect here. There is no alternative. With rates this low and, the Fed's commitment to keep rates low through now 2022, investors will be looking to where can I go to get any semblance of a decent return. We've seen that, exhibited in the NASDAQ. We've seen it exhibited in gold prices, even in treasury bonds and, high quality investment grade as well. Whether or not it's a bubble remains to be seen. I think thus far, valuations, for example, in the tech land have not really mirrored or approached that of the tech bubble back in '99. And that's partly because a lot of these sectors are actually beneficiaries of what's happening in the economy. A more stay-at-home economy benefits certain asset classes, and those are the asset classes that we see getting bid up more. Keep in mind, generally speaking, the Fed will probably be on hold. The next meeting is the last one in September before the November elections as well. So this lower for longer clearly could last throughout at least 2020 and beyond.
Jim, again, we're watching the market reaction here, and it's muted. I mean, there's something to discern. The dollar a tiny bit stronger. Maybe that will pose an intermediate headwind here for precious metals, some of the other things. But the larger question remains, what Melissa was just raising, which is kind of asset prices overall, and this sense that there's not going to be any movement on the Fed's front for quite some time. So let me ask you, especially as it relates to bond yields, the 10-year was at almost a record low going into this. We're still under, I think, 0.6%. Do we just keep falling? Are we just going to be pinned at these levels? What's your read on things?
So I think the yield that keeps falling is real yields. So essentially what's happening is that the Fed is essentially unapologetic and unwavering in their commitment to keep interest rates very, very low. Now, here's where the logical sequencing starts to really matter. So we're talking about gold prices. Well, we have to talk about the dollar at the same time. So effectively, the dollar is the world's reserve currency. As we have fiscal policy, we increase the fiscal deficit. We have monetary policy to keep rates really, really low. There's no free lunch. The dollar, a reserve currency, and also a store of value, is starting to go down. So for global holders of dollars, they need to replace it with something else. So gold becomes something, or silver or precious metals, that becomes something of a store of value. So therefore, you start to get an increase in asset prices. So effectively, what you're starting to see is an easing of financial conditions, which effectively is the Fed's goal throughout this. Because the Fed, what we have to understand, is managing to a worst case scenario with the pandemic. They're not being optimistic. They don't think about a virus and a vaccine in 3 months or something like that. What they're managing is to a worst case scenario. So keeping rates low, the dollar weakening, all of these things help ease financial conditions and helps reflate asset prices. The ultimate goal for the Fed is to reduce the long-term risk of any economic damage that could potentially occur from the lockdowns that came as the result of the pandemic. And their view is that if they're too easy right now, they can take it back later without too much problem. But they better do something now in case things get worse later. And that's the mode of operations that they're in right now.